Welcome to the latest podcast in our Talking Sustainability series. My name is Callum, I'm here with Aimee, and we're both associates in the tax team here at Travers Smith. Back at the end of 2021, 136 countries, including all members of the G20, signed up to the OECD's statement on its two-pillar corporate tax reform plan designed to respond to the challenges of the globalised and digitalised economy. The first pillar aims to align taxing rights more closely with local market engagement, so allocating profits to the jurisdictions in which the relevant business creates value. And the second pillar aims to incorporate a global minimum corporate tax rate of 15%. This was a pretty seismic moment, and one which I think has the potential to have a real impact on the approach multinationals take to taxation. And in this podcast, we thought it might be interesting to set Pillar 2 in the context of the current global drive for sustainability, including sustainable taxation, and to explore how Pillar 2 could be a force for change in that context. So, Aimee, I've slightly taken as read there the link between tax and sustainability. So I think we should perhaps first just set out, in the broadest sense, why tax is an important element of global sustainability.
Thanks very much, Callum, and hello everyone. So I think there are two main ways that tax forms part of the sustainability agenda. The first is what's sometimes referred to as green taxation. And the reason for this is obviously that tax is quite a good lever for behavioural change. So it can either be an incentive or a disincentive, whichever way you want to look at it, for people to act in so-called greener ways. So for example, we've got the plastic bag tax, which might incentivise people to use fewer plastic bags. Or we've got the climate change levy, which encourages businesses to use less energy. And the second way, which has been talked about for a few years now, but not necessarily within the kind of sustainability framework, is what's often referred to as fair taxation. And it's that we're going to focus on today. Now, obviously, the first question that comes to mind is, what does being fair in the context of tax actually mean? And there's been quite a lot of discussion around this over the past few years, and there's quite a broad range of views. So the prevailing view for many years was that businesses should be tax efficient. They should minimise their taxes in order to maximise their profits. And this was absolutely compatible with any concept of tax fairness. But as businesses have come under scrutiny for the levels of tax they pay, so for example through the Panama Papers, the concept of tax responsibility has become more prominent. And this is the idea that businesses have a fiduciary duty to generate long-term value, and that value might be compromised by aggressive tax planning behaviour. So although prudent tax planning is valued under this approach, aggressive tax planning is actively avoided, even if it's compliable with applicable laws. Now some, but by no means all businesses, are now going a bit further than that, and they're advocating a concept of tax fairness. And that provides that businesses must consider the broader socio-economic consequences of tax issues. And these businesses are adopting more of a systemic view, which recognises that there are various different actors in play that are impacted by their actions. And their aim is to achieve an outcome that's fair for all. But as the conversation has evolved around tax fairness and what it means for businesses, a lot of commentators on the topic say that what it should mean to pay a fair amount of tax is for companies to pay the right amount of tax at the right time and in the right place. And this means respecting the tax laws in the company in which you operate, including the policy behind the laws. But it also goes further than that in saying that you should understand how and where your company generates value and ensure that the transfer pricing of a group properly reflects where that value is created. So, under this concept, there's a focus on the people in the countries in which the relevant businesses operate. The view is that given companies use resources in those countries, given that they generate value from the people living there, it is fair for them to contribute to those countries through taxation. Finally, some people are seeing a shift towards the idea that businesses should be seen as having stakeholders beyond just their shareholders. So it's not just about maximising profits for shareholders, but also there's an increasing view for some businesses that civil society is a stakeholder in businesses too. So Callum, I've gone into quite a bit of depth there, and I think we can see there's an increasing theoretical link between taxation and sustainability, and that there is a school of thought that the right approach to taxation can be a key driver of sustainability. But what do you think have been the main practical drivers of this?
Thanks, Aimee. I think I'd like to pick out three reasons here. And the first is increased scrutiny on the amount of tax which businesses pay. The level of general market and public pressure on businesses to adopt sustainable and what are viewed as socially responsible approaches to taxation has been consistently ramping up for the last decade or so. The most impactful examples of this have been the various iterations of the Panama Papers, which, while primarily focused on the tax practices of individuals, have placed tax avoidance and complex tax planning at the forefront of the public's mind and really forced businesses to react to ensure that they are not the next ones to find themselves in the court of public opinion. But it's now more than just pressure, and the second reason I'd like to pick out is sustainability-focused legislation, such as the EU's proposed ATAD 3, which is designed to disincentivise the use of entities which lack tax and economic substance in the jurisdiction in which they're set up, for example in investment holding structures, the numerous national tax blacklists which apply punitive tax treatment to entities based in perceived tax havens, and more recently the EU's Sustainable Finance Disclosure Regulation, or SFDR, which sets out the detail of the sustainability disclosures which certain firms are required to make and which explicitly calls out tax compliance as being part and parcel of good governance. The third reason I'd just like to mention is globalisation, which has brought sustainability more sharply into focus in the context of taxation over the last couple of decades. The principles governing tax systems were historically designed to deal with a world in which most business was domestic and the majority of the value chain related to physical goods. This is clearly no longer representative of the vast majority of economies, and this has created opportunities for the more sophisticated international actors to engage in tax arbitrage.
Yeah, and I think that last point is really interesting, and one which actually brings us quite nicely onto BEPS and Pillar 2. And one of the reasons for that is that what BEPS is trying to combat is what's often referred to as the race to the bottom. Now, race to the bottom refers to the steady decrease in corporation tax rates around the world, which have been declining for the last 40 years. So in 1980, the average tax rate was about 40%, and in 2021, it was about 23%. And this decline has been present in every region of the world. Now, obviously, it's not quite as simple as that, because you need to take into account increased tax bases as well as decreasing rates, increasing reliefs, but I'm not going to go into that now. But why this is interesting is because it picks up on the point that you just made, which is that because of globalisation, businesses have a choice where to set up their companies, their headquarters, their factories. And some of this is obviously going to be dictated by what resources they need or where talent is based. But a huge driver is also the effective tax rate of particular countries. And Ireland is a really good example of this. So in the 1970s, it used to have a corporate tax rate of 50%. It now has a corporate tax rate of 12.5%. And it's seen a huge influx of investment with multinational businesses setting up their headquarters there. And there's a lot of tax competition globally, and governments talk quite openly about this and the decisions they take on tax rates, and corporation tax rates in particular, in the context of the need to attract inward investment and to entice businesses to set up shop in their countries rather than their neighbours. So, Callum, maybe now's a good time to chat through what BEPS actually means and how it might work in the context of all of this.
Yeah, and perhaps if I talk briefly about what BEPS is in general, you can then take a closer look at Pillar 2 and how it could have an impact in this context. So BEPS is an acronym for Base Erosion and Profit Shifting, which in broad terms is where companies use tax planning techniques to exploit gaps in international and domestic tax laws including mismatches between domestic tax systems, to do two things. Firstly, to minimise the amount of tax they pay in jurisdictions with higher tax rates, eroding the tax base of those jurisdictions. This is base erosion. And secondly, to shift their profits from those jurisdictions with higher tax rates to low tax jurisdictions, profit shifting. This can result in corporate tax revenues being disproportionately low and not reflective of the economic reality of where and how those companies operate, and is the underlying driver for the OECD's BEPS project. It's worth noting that the other way of looking at base erosion and profit shifting is from the perspective of the relevant jurisdictions themselves, rather than that of the relevant multinational business. The policy decisions taken by one country and its tax laws and practice can adversely affect another country's ability to collect tax revenue, which is commensurate with its economic output and can undermine its development.
Thanks, Callum. So that's BEPS, but what about Pillar 2 in particular? Now, Pillar 2, in essence, proposes a global minimum tax rate of 15%, which is intended to address the incentives to shift profits based solely on tax outcomes. It only applies to groups with over 750 million euros of revenue, and those groups must operate in 2 or more jurisdictions, and there are obviously other exemptions that apply. But very simply, these rules look at the overall effective rate of tax that a business pays in all the countries in which it operates. And if that effective tax rate comes out at less than 15%, then the business has to pay a top-up tax so that in aggregate it pays the 15%. There's another slightly more difficult concept within Pillar 2, which is called the subject to tax rule. And what this does is give jurisdictions greater rights to levy withholding tax on outbound payments made by their residents in scenarios where those payments are being made to connected parties who pay no or very little tax on the receipt. And for these purposes, the withholding can kick in where the recipient of the payment would pay less than 9% tax on the receipt. So how is the top-up tax actually paid? The primary way is basically that the parent entity pays the top-up tax for the entities beneath it. The top-up tax is allocated to the parent in proportion to its ownership stake of the underlying company. So if the parent owned 80% of the entity, it would be allocated 80% of the top-up tax. And this is called the income inclusion rule. To the extent that the whole of the top-up tax has not been paid under this income inclusion rule, then the second way of collecting the tax is called the undertax payments rule. And what this does is basically allocates the remaining top-up tax to group entities located in jurisdictions that have implemented an undertax payments rule and that either have tangible assets or employees in that jurisdiction. Now, hopefully you can see these are actually quite important changes to the way we approach taxation on an international level, and are really the kind of changes which are needed if a serious attempt is going to be made to solve the issues that we've discussed so far. But there are going to be doubtless hurdles along the way though, Callum, so maybe we should just take a moment to highlight what these are likely to be.
Yeah, thanks, Amy. And I think I'd pick out 3 particular challenges. And the first one is complexity. So Pillar 2 is extremely complicated, and that's typically not the hallmark of a successful policy, even in the world of tax. And this could lead to a lack of understanding and of compliance. Related to this is the fact that transparency, including from the perspective of ordinary members of the public, is a key piece to the puzzle of sustainable taxation. The Panama Papers are illustrative of the growing awareness and concern harboured by the public towards opaque and complex tax planning, and arguably the very complexity of Pillar 2 could stop it from cutting through with the public and actually play into this attitude. The second factor, and the one which will ultimately determine the success of Pillar 2, is the level of buy-in it gets from major economies and its geographical scope. So as we said earlier, 136 countries, including all members of the G20, signed up to the OECD's initial statement on Pillar 2, and this has now grown to 142. This is an impressive starting point and has given Pillar 2 the global heft and buy-in needed to get it up and running. But since then, the momentum which different jurisdictions have carried through to the drafting of implementing legislation has varied. The UK, for example, has raced ahead and drafted legislation which is set to apply for accounting periods beginning on or after the 31st of December 2023, while the US process has stalled somewhat. And finally, while Pillar 2 is clearly a very ambitious project, it will only apply to multinational groups with a revenue of at least 750 million euros. It will therefore only apply to a small group of global businesses, though it's fair to say that this could nonetheless have highly significant impacts on the economies in which these businesses operate. And I also think that the flexibility provided for by the income inclusion rule, which you mentioned, Aimee, creates the possibility that the collection of top-up tax will be skewed towards the jurisdictions in which the parent entities of groups are based, which are most likely to be developed economies, and not towards those less wealthy economies which most need economic support if they're to have a sustainable future.
Yeah, I think in particular on that last point, there's probably a lot more we can talk about on this topic, but I think we'll probably leave it there for today. Should we just see if we can sum up the main takeaways?
Yeah, good idea. And firstly, I think we can say that tax definitely does form part of the sustainability agenda. And there are a number of factors that have contributed to this, including increased public scrutiny and pressure from tax authorities, globalisation, and the introduction of legislation which hardwires the link between sustainability and taxation.
Secondly, globalisation has resulted in mismatches in the structure of tax systems around the world, and the way companies operate these days, and the race to the bottom has encouraged businesses to take advantage of these mismatches.
Thirdly, Pillar 2 is potentially very impactful in this context. It could arrest trends like the race to the bottom and tax competition, and create a platform for what would be seen by many as a more sustainable system of global taxation, or at least an environment which encourages more sustainable interaction between national tax systems, in which people and businesses pay what is, in the OECD's view, the right amount of tax in the right place and at the right time.
But finally, and without wanting to end on a negative note, there are at least 3, if not more, significant hurdles up ahead for Pillar 2. It's incredibly complex, we haven't really got a feel for global momentum, and it's quite a limited technical scope. So that's all for today, but thanks very much to everyone for listening.